What's up, everybody? Good morning, afternoon. Stream's gonna be the catalyst to the 2023 crash. Best Colts I've ever been in, no cap. No market crash until I close my Lulu Condors, please. Oh, rough. What's up, dude? How's everyone doing? Friday was fun. I was best man in a wedding last night. By the end of the night, I was just in a vest with nothing underneath. Both halves of the body or just the top half, Carl? Carl's T might be coming back. How's BG3? Haven't played it. Hydra Wives. Girk gave me the home wrecking DD. That's nonsense. Glowstick, welcome to Dillionaire. Thank you so much. Hit me up on the Discord. I'll get you added after the stream. Hope you're feeling good. Yeah, hanging in there. I took off on Friday. Valid username. Girk, you made me so bearish last night. I didn't fall asleep till 6 a.m. What did I say? I was wasted. The last thing I remember last night was trying to draw comparisons between gun ownership and feeling like you have a second penis. Is Rims and Tim's the guy whose mustachioed girlfriend you stole? What a story arc. I never stole anybody's girlfriend. You can't steal people. They're not property. What happens if we fall below that red box? Armageddon? No. Just, the next line. What part of the Big Short are we in now? Like 13 minutes after they downgraded the US's credit, debt, both. Tim, welcome to Dillionaire. Thank you so much, man. Hit me up on the Discord, guys, after this, and I'll get you added. That way you're in before tonight. No, wives aren't property either. According to my marriage certificate, I own my wife. She's mine. That's not how that... Okay, that's not how that works. Delusions of grandeur. More proof that the pickle jar can't read. I've been noticing that lately a lot with people asking how bonds work. And I know that I've recommended like 4 books that have sections about bonds and also how bonds work. Oh, fuck you, Carl. You said they should be getting close to hitting margin requirement limits on delta risk and IR. Well, yeah. So, I mean, that just kind of means they need to SLD real hard, right? Slightly earlier than anticipated. We skip the bond sections. No, not covalent bonds. I tried asking midweek, but I worded it too convolutedly. Are there, wow, that's a mouthful. Are there any changes coming to daily updates that we've been enjoying? Danke. Um, in the near term, no. Over a longer period of time, I'm not sure it's worth the extra time investment for me to keep doing that every day. But hopefully the market will stabilize over the next few weeks, couple months, and things will calm down a bit. Because I mean, not that I mind, and usually I write about what I expect like the next day in chat anyway. So, but it's kind of a big time sink, and I'm usually pretty busy at that time of day anyway, because I have to set up like conditional orders and stuff for the next day. So, we'll see. For now, no, nothing's changing. They probably even bought the books too. Yeah, yeah, they did. The bonds chapters are so boring, but they're so important. Hmm. The name is Bond, Treasury Bond. When do I have time to read after watching the stream all day and shitposting an SPX all night? Fair. My put's moneyed, so back here after a long time. Game on. Hope you're gold. Welcome back, man. I'm doing good. I bought the books and I'm fucking ready to read them slowly. Well, that's better than not reading them at all. Is one of the books Bonds for Dummies? Because if it isn't, well, do they have a Bonds for Dummies book? They probably do. Is the market going to stabilize in the 3,600 level? Historically, that's possible. I think we're still very, very far away from even being overly bearish, right? Like we've had some nice downside moves, but we're not even below delta neutral yet. And if the plan is an extended period of time below delta neutral, we're very far from that. Yeah, but still not there. So right now, I would say that our risk of bouncing back above gamma neutral is probably higher than it's ever been over the last 3 months. This is the well, an ideal price range for them to try to recover the upside, right? Not that they didn't try Friday and fail miserably, but we don't know if all the sold put positions are one entity or multiple entities, right? So, some of them may be very interested in still saving their ass. Others may already be fucked. It's hard to say. We do know that the 45.25 and 45.50 levels were given up on Friday, but 4,500 and 45.75 and 44.75 and 44.50 are that's up in the air still. So we haven't squeezed out all the short puts, not by a long shot. They go all the way down to 4,000. So we could get more of this type of price action. I do think we have some good momentum. But in the past, that's also been turned around very quickly, right? So I don't think we're like out of the period of time where we have to protect or hedge upside, because it can show up rapidly. I like your daily updates and Pickles picks. Having a 1 month old is difficult to be on Discord. I like reading them when I'm waking up and having a fresh mindset for that day. I appreciate it, man. Thanks, Adopted. Yeah, I mean, I understand the benefit to you guys of it, obviously. And what I was mostly trying to do is condense all the shit that I would say over the course of the night in SPX chat and just, put it in one write up where everybody could find it and not have to like scour my post history, right? I'll see if I can continue to do that. Right now, the time allocation is a bit of a problem, but I still feel that it's necessary. If we move into a phase in the market where I don't think it's as necessary, I may slow them down like 3 times a week or something like that, but we'll see. If basically, here's the deal: if it starts losing me money, then I'm not going to do it anymore. If as long as it's not losing me money, then it's fine. I was just gonna ask you to talk about chances of a bounce. We had similar drops Thursday 727 that almost fully recovered the next day. I don't think we had the same market structure on 727. There was significantly less volatility risk. We didn't have a US debt downgrade. We didn't have a slight flight to safety that we saw Friday. We didn't have oil pressuring inflation. The macro environment is totally different. And so while the past may rhyme, it may not repeat itself, right? Is it possible you could train a quant to do the dailies? Yeah, that's probably not going to happen. I think in regards to that, all of us have far more important shit to work on than daily updates. The more I look at this, the more I think big money is swinging bearish, and this may be why their pumps to gamma neutral are short lived. Does this mean strangles are better now? Not yet, but we're getting there. Maybe VIX above 18 consistently. I would say that you could start to explore strangles. Um, Maybe a little, probably still pretty narrow, right, for overnight. Like next strike from the money, but you can broaden that as VIX moves up. So if you get a sustained period of like VIX 18 to 24, then strangles can be quite good. I'm actually making money these days because of your write-ups. Big love. Yeah, I mean, I want people to have that daily information so they're, up to date and they understand what is required for positional management and what the landscape is of the environment they're trading every day. But at the same time, I don't like hand holding people, and it feels like it does that a little bit. Um, and that's not good, right? I mean, something could come up, I could miss a night, and then you become over reliant, right? Like I might just pass out one day after the stream and forget to write it up, and then everyone's gonna be like, "Oh my god, what happened?" The midweek additional pickles picks are awesome too. Yeah. Well, that part actually is better. Um Not only because of our like insane like price volatility in the market right now, which makes week one like 1 week out picks generally just are good like the first couple days, right? And that's something a trend I've been noticing with pickles picks over the last couple months is that they're like valid for like a day or two, right? And then you've got to be out. And having more frequent updates on those is actually beneficial and provides higher accuracy. Which that I don't mind. That's usually pretty easy. That's not the hard part. The hard part is doing like all the like options chain analysis and everything every night, and then writing about it. But for now, they're going to continue, so don't worry about it. We'll revisit it in a few weeks and see where it's at. I thought the SCX Discord was for shitposting only, mostly, but also commentary on the SPX. Sure, a lot of people in here this Sunday. Well, big move, right? Doesn't the market always go down hard whenever Dirk goes away on vacation? Can you banish him to Siberia? Dork is home, so do with that information what you will. 1 second for entry, guy. So my 4550P, 4500C strangle at 4575 is going to be okay. 4450P, 4500C placed at 4475. Yes. I hope you weren't buying. Uh, no, yeah, that's definitely 44. Okay. Doesn't the market always go down hard whenever Dork goes away on vacation? SPX chat is the best part of the Discord. It's pretty fun. Dork is home equals full port calls. If you believe that Dork is an indicator of Dork's location is an indicator of future price movement, then sure. What's up, Dork? How's Upstart look for earnings? Was it shorted last week or just down with the market? They've been shorting Upstart pretty aggressively for a couple weeks now. They finally just got some liquidity to actually bring the fucking price down. There's been put sweeps coming in for like 3 weeks now, so a little bit of liquidity freed up. I don't know how that's going to turn out yet, but it's still in a fairly stable range above 60. And I really wouldn't trust like continuation of the downside until it falls below 50. Earnings is coming up and it's on Tuesday. Yeah, Tuesday. So oop, shit, hold on, I got a call. Hold on 1 second, guys, I gotta grab my food. All right. So yeah, so below 50, it might start to actually pick up some momentum. It falls below the majority of the puts and the majority of the short calls at that point. A lot of those short calls were further dated, so it could start to accelerate the more we fall. But remember, it's still going to be at this price. It's still going to be super sensitive. And if Upstart beats, it could run more, right? So something to consider. I don't know if I'm gonna play their earnings, but I'm still thinking about it. I'm not gonna play them directionally, but I might get exposure if Ivy's really crazy. Oh, just noticing the market went down while I was out of town. Of course, as it does, right? Ooh. They delivered my food to my neighbor's apartment. Upstart earnings straddle? No, not straddles. Straddles are awful for earnings. Yeah, it could work, but they suck. You get IV crushed. Having fun with VIX this week? Yeah, it's pretty cool. If NVIDIA starts sharding itself, it may drag down Upstart like a rock. Yes. And that is a consideration. NVIDIA, Palantir, Upstart, all of Bot's holdings. If Bots becomes more liquid, Upstart starts gaining downside momentum, it can drop just as fast or much faster than it rose. Also, if they miss earnings, or their guidance is pulled back due to the fact that the Fed is likely to increase rates another time, which is obviously very bad for their business model, then, any provided liquidity is going to really ramp up the downside there. So it could drop really, really fast. It's risky. I don't know how else to describe Upstart. Not only is it hard to make money on, it's well, yeah, it's just hard to make money on. It doesn't matter what direction you pick. You're incentivized to be a seller of options on it far more than you are a buyer. GME this week is probably something we should go over as well. So GME has ETF FTDs. Of I believe it's like 1.5 and 2.3 million over the next 2 days. We had a bit of volume on Friday. Obviously, ETF FTDs over 1 million. Are historically relevant. And this is 2 days over 1 million. We did see some volume Friday, and we may have seen some covering as they took advantage of the market drop. If that is to continue, it may see some price improvement, especially if it squeezes out any near the money short calls. So your guys' covered calls. Or slightly further out of the money short calls, the institutional naked ones. Then it could have a little bit of a run. I don't know if Gamma Max is possible. Probably not. And if the market drops into this, then all the liquidity will get scrubbed without any price improvement. So, risky. And since the market's current trajectory is down like a rock, maybe even more so. What's up, Skarn? Fubo got back a lot of liquidity on the sell-off on Friday. I don't know if it'll recover from that. It may. There was definitely some buy pressure. There's still some interest. I know it kind of bounced back a little bit when the market stabilized in the midday, but with everyone selling calls at 3, we're probably going to stabilize around that range. We might not revisit like 230 or sub 250 without a bigger drop in indexes. I think obviously their earnings was pretty good. Things are on track as they're expected to be. Thanks, Carl. Any reason opening a wide straddle on Upstart and Baba Monday and selling before earnings is foolish? How wide? You need a lot of theta to do what you're talking about. You're trying to capture the spike in implied volatility. It's probably too late for Upstart. Most of the expected moves probably already priced in. It might increase a little bit. Baba, you might have time. Baba's earnings are on the 10th. So you might have a little bit of time to do that. Not my favorite play. Generally speaking, it's a net loss trying to affect that strategy, but yeah, you can try. Everything is risky. Yeah, VIX is up. All right, what else? SPX, I guess we should cover this. We've got continued decline in dealer Delta and Gamma. Charm is starting to move a little bit negative, but barely. Put interest is picking up, but not a lot. Call interest is falling off really hard. If that continues, I mean, we're already at one of our like almost our lowest levels since like May. But I mean, we are seeing long calls closing out pretty rapidly. Some of those with theta. So hmm. Are we seeing an increase in sold calls? We kind of dropped a little too fast Friday for a lot of them to build up, but there is an increase of them above like 45.50. Hey Girk, popping in a bit late. Thanks for what you said this weekend. For someone who doesn't care about his viewers, you have the biggest heart of any pickled themed stock YouTuber I know. How many of those do you know? I don't know what you're talking about. You people drive me nuts. That's the only 10,254th time I've heard that joke. Nice. Upstart earnings straddle. No, because IV crush. There's better ways to play earnings. Happy Sunday to you too, Skarn. Let me see if Dork and JFresh are around. Oh yeah. Maybe. You said you sold bear call spreads at 45.05 on Friday. Can you talk about when you entered them? Like first thing in the morning? And what made you do so? I kind of thought that's around the price we would close. I actually entered butterflies. Well, not really butterflies. Something sort of like a butterfly. It's uh, like a call broken wing, or a skip strike butterfly. So you held through the pump attempt? Yeah. I mean, the spread on them was only $5, right? So I sold 45.05, and I bought I think it was 4,500 and 45.25, like that. One second, I gotta fluff up my peanut real quick. All right. To ring fly. So you held through the pump. Why are bondholders said to have different expectations than shareholders? Thanks. Hmm. 1's the holder of debt and 1 is the holder of equity, right? Obviously, both of them um, want long-term success for the company, but that can skew a lot depending on the health of the company, right? DMs. Ooh, interesting. Huh. Well, thank you, Carl. Can you post that in the GME chat and pin it? If you get a chance. Is being below GN of SPX a decent position for longer dated puts? It's still risky. You could enter them, but I wouldn't enter them without a hedge. This is probably a time where longer dated debit spreads are really advantageous because IV's a little elevated, but you still need some protection from a move against you, and you may need to carry the position for longer. So having that offset theta decay is also beneficial. Thanks, Carl. My Uber Eats order the other day came with a 4-month free Siri subscription. Is this bullish? Obviously, yeah. Does Siri have like a digital like streaming platform or something? Like a Spotify? Because they own a lot of content. And arguably better produced content than Spotify has. Any new tinfoil theories? Japanese storage unit containers full of crude heading out of the Russian Strait. Japanese storage unit containers full of crude. How do you fill a container with... I don't... okay, like barrels of it, I guess. They're still buying oil from Russia. It's not like we can't buy Russia's oil. How do you think Russia's funding their war? There's restrictions and stuff in place, but everyone's still buying Russian oil. I saw some advertising for Siri and I actually thought to myself, hey, this product is pretty good. Oh boy. Okay, we need to never talk about Siri again. SiriusXM's app is basically the same as having the satellite subscription and hardware. Okay. See, I could see the company pivoting into that. And that would be advantageous, right? There's a lot of, actually shockingly, a lot of market space there that you could capitalize on if you have a lot of content. With the market being so crazy lately, I think everyone wants to know when game stream with you and the quants. 49 Russia, 51 other split, and you get around it. Shell started day one. Yeah. You just can't buy all your oil from Russia. All right. Here's Dork, and I've got about 22 minutes before I have to go do other stuff. What's up, nerd?
Just running into issues with VS Code because tabs and spaces and Python sucks.
Okay, nice. Sounds like a fun weekend.
Oh yeah, dude, it's full of excitement. It's so eventful. I've laughed, I've cried, I've lost 5 pounds, the whole gamut. So Thursday and Friday, I had to be away. I saw there's a big drop on Friday. That was pretty interesting.
Yep. They started pulling back the sold puts at 45.50 and 45.25.
Ooh, that's spicy.
Yeah, we went down hard and VIX rocketed.
Nice. Yeah, I haven't gotten a chance to really kind of dig into all the market action as of yet. Too busy with.
I think we had a 75 BPS candle on the 1 hour.
Wow, look at us. Whew. I should probably pop up my thing with all my crazy squiggles, but I don't know. I think that I think that the market might be preparing for a bunch of bearish data in the next week.
Well, CPI is interesting. We had that crazy beat last time, but oil prices have been rising pretty steadily for over a month now, right?
Yeah.
And remember that year-over-year CPI can never be greater than 0.3. Or the month-over-month, rather. If the month-over-month comes in greater than 0.3 at any point, it reverses our trend of disinflation. Which, yeah, could absolutely be very, very bearish, right? Especially with everyone so focused on fucking headline all the time.
Yeah, and what's interesting about that is this is going to be the first month where we don't have that June base effect anymore, right? With the huge peak, in inflation that's gone. So I'm interested to see where it ends up. I mean, really, no matter where it ends up, it'll be interesting to see how it shakes out. So that's one I'm looking forward to, just to see, because that'll give us our first real indication, I think, of where inflation is headed.
Yeah, and I think I really think the next 2 months of inflation data are very, very important, because if we get a reversal in the disinflation trend this month and then next month comes in steady, then we're now up year over year, right? And that means inflation's starting to accelerate again. Although
Yeah.
technically speaking, that could, with the seasonal adjustments, that could happen this month, depending on how volatile the move is. But I don't think oil was high enough yet to be additive. But next month, if oil holds these prices, it is high enough to be additive. And additive oil is like a 30% increase in the like positive inflation rate, right?
Yeah, I don't know, man. I usually fill up about once a month since I work from home, and my month over month per gallon gas charge was up about 15%. So I mean, that's that.
Mm-hmm.
It probably just happened in the last week or two, I'm guessing too, with the bounce in commodities. But I'm also close to the West Coast, so oil's just more expensive,
Yeah.
or gas, I mean. But yeah, interesting stuff. And then there's some other data too. There's the unemployment data is starting to look pretty interesting. It's actually, I think, kind of softening.
Um.
So
So is it?
they've
I
had
feel
like
like
revisions,
this is the
right?
other part that's kind of more bearish, is that labor data is still looking really strong.
Well,
Like,
I think that labor data is a little misleading, right? Like the hourly wages have kind of stagnated, right?
yeah, they have,
Or hours worked, I guess you would say, is the better metric to use. So,
but
you know,
productivity is still meh, while wage inflation is up, right?
yeah, yeah, and that just goes to show that most companies are focused more on worker retention than revenue expansion, right?
Or they're both.
Yeah, I mean, you obviously always want revenue expansion, but you know, the what I'm getting at is that like you want to hang on to these employees, but you don't have a lot of work for them to do, so they're not exactly clocking in the hours they once were.
Well,
But
you,
at the same time, you got to pay them enough to make it worthwhile for them to stick around.
I mean, yeah, I think we are in a period where like labor hoarding is more incentivized, but I think we've already been in that for a while, right?
Oh yeah, since 2021, yeah, for
Which
sure.
means that, with those changes, we're probably entering a period of like through from now through the end of the year, I think we're going to see more layoffs. We're going to start to see like another cycle of layoffs pick up that'll probably peak after the end of the fiscal year.
That makes sense. That makes sense. Um, yeah, I like the industrial, like manufacturing PMI and all those things are still coming in at a contracting rate. So
Yeah, it doesn't, manufacturing still doesn't look very good.
yeah, that's
There are pickups and orders, but I think that's also just like a aftershock of the asset bubble reinflating. And here's where I think we're going to see the inflation growth is on. So since we didn't see manufacturing pick up, right? And we didn't see manufacturing orders really pick up until now. I think the higher demand on uh, durables is going to be reflected over the next two reporting periods. And I think the demand for those is being suppressed with pricing and not with additional inventories, because I don't really see any inventory or new order growth.
okay. That makes
Which,
sense.
yeah, which means that the discounts that were starting to come in on durables are going to reverse, right? At least briefly. So that could also push core higher over the next 2 months. I think all of it really kind of
Yeah.
just spells out that the Fed's pretty likely to move forward with another rate increase.
Yeah, it's interesting. Like the whole economic situation is just so freaking, opaque. Like you can't really like everyone wants to say this economy is incredibly resilient, but I feel like we're still just seeing the lag effects in earnings from quantitative tightening because so many large companies are able to get, cheap debt and they're still, living off it. But S&P earnings, at least so far, we're looking at a like a 5% year over year decline in earnings
Yeah.
in the S&P, which is, and there's one side of that to say, well, it's only a 5% drop, since in that year we've hiked rates so much. But, to that, I sort of ask the question of perhaps we're seeing a more lagging effect in the impact of rate increases on the real economy because of the massive amount of stimulation we provided the economy in the years prior, right?
Yeah, so kind of still that acceleration of the money supply issue, right?
Exactly. Yeah,
Yeah.
and it's when you argue with the bean counters on the internet, they point to a lot of data, and it's if you look at news articles from certain periods of time heading into recessions where it like now it was unclear but it looked okay, right? Everybody who everybody who is some sort of analyst with some semblance of clout
Yeah.
goes full bull, right? They're like, yeah, we're perfect, we're good. This is the Goldilocks zone. We're doing excellent, right? Like going all the way back, even heading into the Great Depression, it was the same thing, So I just, and I'm not saying that they're necessarily wrong, but I'm not gonna put a lot of faith in that prediction when we have still not seen this sort of crazy situation unwind in any appreciable way, right? Like 2022, prices fell because analysts got bearish, right?
Yeah.
And they got bearish because prices were falling, right? So, now it's 2023, analysts are getting bullish because prices are rising. Earnings have been okay, right? The economic data has been all right, but you kind of have to ask yourself, right, is this part of just the economic cycle, seasonality, all these things, and also whether or not it's a combination of these sorts of cycles, and there just being so much money to have to unwind that's just sloshing around in the giant bathtub. So it's it's going to be interesting, and I feel like in these next couple months, because generally speaking, the second half up until holidays, for consumer discretionary, it tends to be slower for most businesses, and also, it's gonna. I find that this next few months are going to be really really interesting to see. I think more real effect from the Fed tightening cycle, from the commodities rebound, consumer
Yeah.
spending habits, how they're changing. Um, we're
I
going to
think
get a
I think
lot.
the Fed's going to start to get scared again because commodities demand generally picks up into the latter half of the year anyway. Um, and with oil moving so quickly into like the peak demand season, the effects of that on like winter fuel oil and um, winter fuel oil, diesel, and nat gas could all accelerate into their high demand season at the towards the end of the year, right?
Yes, the winter blend,
Yep.
whatever that means.
Well, not just winter blend for cars, right? But like, that's like our biggest trekking season between August and uh, like through Black Friday into like Christmas. So diesel demand skyrockets. Um, Fuel oil demand skyrockets for homes without natural gas, mostly in the Northeast, but some in the North Middle West as well. And then if it's a cold winter, nat gas and European demand on nat gas too.
Yeah, yeah, it's going to get interesting. We're it's going to get spicy, right? And then September we got, all the asset managers are going to be looking at their portfolios and asking some questions and coming up with some answers.
I kind of wanted to talk about something you just brought up. I was talking to my one of my buddies over the weekend. We hung out for a little bit and We got some drinks and stuff, and he's like a social media engineer slash manager for like a smaller fund. And he was talking about like the massive growth in these like hedge fund interest in social media sentiment, and how like since GameStop really, that market has exploded, right? And even like analysts that I kind of once respected have moved into this thing where they're so constantly pressured by what people want to hear that their analysis has become subjective instead of data driven, right? And I think this is actually a big part of this whole run and our like this new market environment that we're moving into, is that analysts, for fear of reprisal, and reprisal is swift, right? Especially on social media, they don't give they're not giving out, even remotely honest, um or think about a better way to put this. Not that it's dishonest, it's they're skewing their analysis to match uh overall sentiment so that investors stay interested or stay on board, right?
Mm-hmm.
And a lot of that social media marketing job for hedge funds is bringing in new investors, right? And if new investors are like, they're like, oh, that fund is bearish but the market's going up, I'm not going to put money with them, right? And so there's this big incentive drive to be the guy, like to be Mr. Right Now instead
Hmm.
of Mr. Right. And I
So
think
that
that
makes
I
sense.
think that's an underlying. I don't know how big of an effect it is, but the effect of that is growing.
Right, like populism in the markets.
Yeah,
I mean, it kind of makes sense, in terms of the trend of just overall society. And I mean, analysts historically really their job is to go ask the company, "What's your EPS going to be?" And then they just say that's their estimate. And
yeah,
and so now they're just adding on a little bit of extra, zhuzh onto that, and yeah, and you're right. There's definitely knock-on effects because now you're creating a majority uh, through these analyses that paints a very rosy picture,
yeah,
right? Like because the market is forward-looking by 1 to 2 years, at least on spot, and as all these analysts are coming to consensus, I guess that's the plural of that, that are
yeah.
they're coming to a consensus
I
that
think you
is
could just say a consensus. Yeah,
yeah, they're coming to a consensus that is it's super duper duper rosy. And so once that happens, then you got news articles showing up saying that J Pow's nailing the soft landing. Companies, outlooks are looking up, right? And all these things because so much weight is placed on the publications from these analysts.
yeah, yeah.
So
Especially,
yeah, like
especially the big banks who more than anything right now, and this is kind of where our conversation fell, was the big banks more than anything right now need depositors. They need
yeah,
people coming in with money. They don't care where, right? And you notice the big banks are the first to step up to these, not. I don't. I think undefensible valuations, right? Which is borderline fraud.
oh yeah. Well, did you notice that after the Fitch downgrade, several GSIBs, I think it was two or three of them, within days, retracted their recession calls?
Yeah, yeah.
That was very, very. I found that to be more interesting than the downgrade itself.
I mean, but
Yeah.
the thing about this is like if you're constantly stoking the fire of sentiment, when you get a mechanical correction, it's going to be so much worse.
Oh yeah, well, I mean, even more scary is once you're proven wrong, right?
That's like,
That's the
yeah,
worst.
that creates panic.
Yeah, and because analyst expectations are so rosy, right? I mean, if at some point the writing is on the wall for these companies, the analysts go to them and say, "Hey, what's your EPS looking like, for this next quarter?" And they say, "Pretty disappointing." That instantly right there puts everybody in a difficult spot, right? Do the analysts lower their forecasts? Do companies issue guidance? You know, and how does sentiment shift? In the narrative and the media, it becomes a whole mess. And I'm interested to see, like I said, second half, what sort of, I put my ear to the ground and I watch, Bloomberg and all these things. It's going to be interesting to see what people are saying about the near term outlook heading into the second half, into the throes of September and October, uh, you know, especially since S&P earnings this time around were once again pretty frickin' milk toast, right? It wasn't like this, we're not seeing an economic recovery. We're seeing the mild slowdown. By all measures, right now we are seeing like the soft landing, right? And,
Yeah.
and, and I mean, we're seeing reinflation in commodities, of course, but I'm gonna not go off of that data and go from like what's been printing out in the economic data reports.
Yeah, I
Uh,
mean, well, we're beginning a soft landing, right? But how soft is it going to be? I mean, like, this is something I wanted to point out too. Like, Apple lost 400 billion in valuation in 2 days.
yeah,
That's more than I think the Treasury General account's currently holding. That's more money than the government has.
yeah,
And they lost it at
yeah.
a rapid enough pace that most people did not get out of this. People who
You
have
wouldn't have had time.
been buying since June are now underwater. Since the
Yeah,
beginning of June? Yeah.
yeah. I was looking at the Apple Daily Candle, dude. That thing's nuts. Like on Apple of all the companies, it's the biggest company in
This
the S and
is,
P.
I think, the largest drop in Apple in since Jan of this year. This may be the largest drop in Apple ever.
That's a really big drop. There's some
Maybe ever.
comparable in December. Uh,
Hmm.
I think there was a okay. So, oh no, not even the June almost crash of last year. It didn't drop as much as it just did.
October of last year, it lost almost the same amount from its peak. It
Gotcha.
did lose the same
Yeah,
amount from its peak, but that was it. Yeah, that was by far the worst one. This is really bad. I mean, this
yeah.
is
That's
7.5% of the S&P.
yeah,
And yeah, a lot of people are gonna be like, well, Amazon beat, but Amazon is only 3% of the S&P, and they only gained 274 billion after Friday, and that could just slump even more tomorrow.
yeah. No, I think that Apple might have been, you know, not necessarily the canary in the coal mine, but the giant elephant in the room, right? And I don't think that Apple having a disappointing earnings is necessarily a big surprise given we've seen semiconductor manufacturer after semiconductor manufacturer, your Samsungs and TSMCs and all these guys,
I mean,
with
Qualcomm's been pulling back guidance for like 3 quarters now, while Apple's just tearing upwards, right? Qualcomm's like,
yeah,
yeah, we're not selling any fucking chips to anybody. And Apple's like, ah, we're great. We're gonna sell so many fucking iPhones and VR headsets for $4,000. Don't worry about it, guys. But like, they're not, right? It's kind of like Nvidia with TSMC.
exactly.
Because
Exactly.
TSMC has been like, we're not making chips for anyone. No one's buying any of this shit we make at all. And meanwhile, Nvidia's out there saying, yeah, we're going to make, 8, 12, 16 billion in sales quarter over quarter for the next 3 quarters. And that's just not possible. TSMC makes all the shit. So if they're not, just inundating TSMC with future orders, they're not selling anything.
Yeah, and that's kind of what I was getting at is we were seeing at the input level, we're seeing, sales declining by just monumental amounts, right? It's just I don't, extrapolating out to the output level, your Apples and your Nvidias and stuff, it's just it doesn't add up, right? And
Yeah.
and that's why the future valuation that the market is currently giving these companies, like while I agree that there is growth potential in them, obviously, because companies will grow. These aren't like terrible companies.
No, I
The,
don't disagree with that at all.
the optimism around them, though, in the near to medium term, the 1 to 3 year time frame is just it's off the charts. And anybody who looks at these valuations, given the broader context and has some semblance of logical reasoning, has to be, if they're long, they got to be considering, risking off into something like treasuries. Um, or if they're
Yeah.
not
I
long,
mean, I
then they're
mean, if
just
you're
not
if
going
you're
to
long
justify it.
Nvidia from $130, right? How do you defend holding that to your clients? You can't at 400. There's no way. How are you gonna price in 6% more growth on top of what you've already made? And yeah, that's likely the biggest catalyst to continued sell-offs.
Yeah, and that's why I like your call for September because, if rebalances happen, right, there's going to be a big dispersion trade into smaller caps if the outlook is looking good, but you look at like the S&P 600,
Mm-hmm.
their forward PEs are, and analyst expectations on them are not good.
No.
Like like you look at them and it's like it doesn't look like you would necessarily be stoked in buying these smaller companies.
Yeah. I mean, the Russell's a little better with its because it's slightly slightly better on the cash flow side. But yeah, both of them. I mean, Russell 1K is actually starting to look pretty good. Um, but yeah, I think more and more funds are going to start focusing on cash flows, especially if we start to see a declining dollar, right?
Yeah, yeah. Oof. Sheesh Louise, man, a declining dollar. Talk about J Pow's worst nightmare, right?
Yeah, yeah.
But I mean,
Yeah, because that
it,
that that just so you guys understand, that robs businesses and consumers of purchasing power. And if the dollar's strong, we can keep up with inflation and demand can stay high. But if the dollar weakens, we can fall behind really, really fast. Consumer sentiment can crash on a weak dollar, and then also you're dealing with the effects of like carry trades with Japan, and I'm not going to get into that with this, but
it's interesting actually. So dollar dropped 47 basis points while S&P dropped 50 basis points on Friday.
yep.
That's very interesting.
And there's definitely some like flight to safety going on too. If you look at the 2 to 30,
Oh yeah, yeah. And also Japan strengthened against the dollar in the drop too.
yeah, because they're selling U.S. Treasuries to go out to the market and buy Japanese bonds. The yen got up to like, or USD JPY got up to like 143. That's really fucking bad for the yen, right? And then like if it goes above like 145 up to like 150, then you're looking at like the Japan needing to peg to the dollar, right? Before their
Yeah.
currency collapses. And if they peg to the dollar, just so you guys understand, that means that they peg their monetary policy to the dollar's monetary policy, which means Japanese uh, interest rates would go from 0 to 5.5 overnight.
Talk about a market crash.
Yeah, did you see me giving Bill Ackman shit on Twitter?
No, you gave Bill Ackman shit. I love it.
Yeah.
That's awesome.
He's trying to get everyone to provide liquidity for his treasury short. He's like, shorting US treasuries right now is asymmetric risk. And I was like, the fuck it is.
Wow. Fucking, what is he on about? Like,
I mean, Ackman always goes to the public with his fucking plays when he's in trouble.
yeah, like I just, oh, the whole Treasury situation is so weird. There's the largest short position on Treasuries ever right now.
Yep.
So, yeah, God, it's just this. As soon as J-Pow cuts or the carry trade starts to fully collapse, the yields are just going to do the craziest shit we've ever seen. They already
Yeah.
have been doing that though, like the moves we saw like in the later half of 2022 heading into 2023 and into the first half of 2023 were just monstrous. These drops, right? Like these, having the 10-year drop 14 freaking basis points in a day. That's crazy. I mean, we're everyone in chat here, we all kind of were like, the meme stocks really got us sort of desensitized to these, big moves, but it's not normal for the 5-year to drop, 3.6% in a day. That's not normal at all. That's fucking crazy.
It's
Like,
okay. Move's gonna skyrocket. And then convexity hedges against VIX are also gonna go nuts. I love it.
it's
I
just
just I
crazy.
just hope we open tomorrow at like 3,500.
I hope so too. Like, it's just I don't want these moves, no pun intended, to get lost on anybody. Especially when market's been up a bunch and everyone's being all bullish, out there in the Gen Pop. That we're not seeing a healthy financial system, in terms of movements of things around,
You mean like a
in their
healthy
stock
financial
price.
system that could support the valuation of multiple multi-trillion-dollar companies?
Yeah, exactly. And do so with the most shady means you've ever fucking imagined.
When
Like,
SPX forward guidance, they've canceled their earnings calls more often than RC, and that's frankly outrageous. Shout out to Twat Waffle, Riku. Uh, yeah, I agree,
yep.
Dork. It's what's the PT on Fixie be in that case? Oh fuck. I mean, if Japan pegged to the dollar at all-time highs, but more than all-time highs,
Yeah.
way greater than it went during like the uh like post global financial crisis period. And I think back then it was like what one like in the 130s. I just want you guys to know this conversation is what I'm here for. Dole has their own treasuries. Yeah, oh, don't forget food inflation's been picking up too, Dork.
Yeah. Well, yeah. Yeah.
With the shit in Crimea and Russia, and then India cut their non-basmati rice exports
I saw
because
that.
they're facing like an internal food crisis. Um, Yields for the year don't look phenomenal. They look okay, but that could also mean like that might be a longer cyclical effect. Like that may not really be pronounced until like next year if there's low yields. Like if low yields compound next year, it could get really crazy. But um, because then you have less food storage. But that's definitely heating up.
Jesus, dude. I'm just looking at daily charts of the different yields. Oh God, this.
But this
This
affects
is so
oil in any
crazy.
way? Oh, absolutely. Yeah, a lower dollar value, uh, because oil's priced per barrel. It's almost its own currency in a way. But a lower dollar value raises import oil costs. Since the U.S. imports most of its oil, it can a lower dollar value can see the price of oil skyrocket, and then
Yeah,
speculation can take that to a level that is completely unexpected.
there's like a two-sided effect of the dollar price on oil, right? Because oil is primarily transacted in the dollar.
Yeah,
So, there's that direct inverse correlation, and then there's also the momentum trade into oil on a falling dollar, right? As people move into oil to speculate on a further increase in its price as the dollar falls further, right? So people are going to want to buy oil now to avoid having to buy it at a higher price in the future, right? And you'll see an effect of that is a widening of the contango in oil prices between the futures and the spot price of oil. And it looks like we're seeing a little bit of that.
starting. Yeah,
So that's a sign that there's either people are getting bullish on oil or they're getting less bullish on the dollar or both or some sort of mixture of the two. But that is interesting. I did notice. I just looked. I was like, yeah, the contango's now it was at like 9-10 cents just at the beginning of the week. Now it's up to 30-cent spread.
yeah.
So yeah,
I
that's an
mean,
interesting
Bank of
metric.
Bank of Japan being forced to step in almost immediately with bond buying, after loosening their yield curve control, really shows the amount of demand on pressuring that positioning, right? And if the Bank of Japan is stepping in to control their currency, um, so quickly, I mean, like the fucking BOJ yields went up like some of them went up like fucking 2,000% in a day, right? So someone's actively shorting uh, Japanese bonds and going long U.S. bonds, right?
Oh
And that
yeah.
that forces the Bank of Japan to come in and sell U.S. bonds in order to fund purchases of their own bonds and maintain their yield curve control policy. But if that goes on long enough, if the speculators can outlast the Bank of Japan, Bank of Japan will have to do something more extreme.
Oh yeah. It was like watching an invasion in real time on Japanese yields. They just went to the moon, Well, went to one.
Yeah, but that is
But
the moon, right?
yeah, exactly. I mean, that's in terms of percent changes, like you were saying, like some of them were just ridiculous because of the divide by zero. But you know, when you set the max interest rate for Japanese debt at 100% higher, right, you shrink the return on arbitrage between the Japanese bond and the American bond by half.
Yeah,
And that has a very significant effect, and is
especially
why
when
we
you're
saw.
leveraging up U.S. Treasuries, right? Like
Oh
if
yeah,
you're
yeah,
taking mature treasuries to Japan and leveraging them up with the Bank of Japan, your 5, 6, maybe 10x your initial deposit, right?
yeah. So the idiosyncratic risk rests in the yield on the Japanese bond. It's the it's like a transistor of sorts, right? Where a smaller current, i.e., the Japanese yen, is used to control a larger current, which is the U.S. dollar.
Yeah,
And as and because your margins shrink so drastically, it sort of necessitates, in order to maintain the same liquidity flow, it necessitates you to have to double the amount of or sorry, you have to double the utilization of this carry trade in order to maintain the same amount of liquidity flow.
Yep.
And so so your choice is either to back out of the carry trade
That's
or
also called beta.
or you either back out of the carry trade or you double down into it, right? Those are your kind of your choices. If you stay the same, you're just going to end up, you know, or you shift your allocation, right? I mean, that's the other side of it too. You could just go long the treasuries and then just sit on your ass, right?
Yeah.
But in doing so, your equity portfolio starts to suffer because it requires these liquidity flows to maintain the prices that it's at. Because there's
Well, you
not.
also have to maintain your minimum margin, right? And this is in 2008. This is what triggered the beginnings of the sell-offs in mortgage-backed securities, and well, yeah, and mortgage-related securities. Was that as the yield spread narrowed, they had to increase their holding collateral with Bank of Japan, which forced them to sell securities, right? And that then lowers the valuation of those securities. So it becomes kind of reflexive.
Yeah, and and so yeah, we're just kind of dancing on the knife edge of like I guess the whole market, that particular market coming to a decision.
Yeah,
And whichever way it goes, right? Like we may see, right, if the Apple's earnings may be the writing on the wall that kind of influences the decision along with oil rebounding. Um, that could be what makes the decision, right? You don't just get to make the decision on that level. I mean, we talk about the institutions doing this and how huge they are, but there is, a broader market that is, being transacted by governments and,
that's much bigger than the sum of its parts.
exactly, yeah.
Yeah,
So at some point the decision may be made for them, right? And while fear was high and liquidity was low, making the decision for the market was easy enough. But as the market comes to a consensus, it becomes harder to force it into a mentality of your choosing.
yeah,
So, SPX liquidity has been really low all year. And, because of that, it's possible that a consortium of institutions with the same goal in mind could affect the outcome of a situation, right? Or the mean consensus just purely through their own influence.
yeah,
But as the market starts to come to its own conclusions, that sort of illiquidity, the illiquidity dries up, because liquidity goes up, but it may not be the liquidity that you're hoping for, right? The dream is to get everybody on board, right? And they've done a pretty dang good job, but irrefutable evidence is hard to deny, right?
yeah,
So that's where we're kind of at, right? Like the inflection point, right? I mean, we just witnessed the most insane face ripping launch off in the market. We just got a year and a half of gains in like 6 months. And that doesn't just happen, right? I mean, we acted
or
like we bottomed out of a crash. Like in reality, we had a pullback because analysts got bearish, and then they absolutely fucked up their recession call in their minds, and now they have to do a complete about face, and the market is just following them. That's
yeah,
not. There's no real reason for it, and the market just following them is purely these analysts. It's who they work for. Reflecting their sentiment,
yeah,
and
and meanwhile, while market data looks okay, economic data has only gotten worse.
Yeah, and it's the we and that's the thing is everyone calls this the soft, and like I said before, this looks like the soft landing, but in reality, it's just a softening economy. Like
Yeah.
you can't ascribe an outcome to a snapshot of in time, right? That's like you take a picture of you look at a chart going down, right? You can and if you just look at the chart with no context, you're going to say it's going to continue going down, but then you ascribe all of these sort of intentions from all these outside influences to it, and now all of a sudden you're providing a very biased prediction about what it's going to do. Like if like it's like showing a chart of GME going down to a bunch of super stonkers, they're going to say it's the dip before the rip, right? Because they've ascribed evil hedges and short squeezes and all these things to the price of GME. While you probably like your head's in the right spot in terms of these outside influences, you really can't, you know, extrapolate those influences forward and assume that it's all just going to do what you want it to do. So I like there's to me there's two outcomes, and so we have like if you imagine like a cone or like a triangle, right, down and up and then flat, right? We have a K-shaped recovery in the economy. Services are doing great. Banks are killing it on their investment activities, but
But
manufacturers
still doing
are
really badly on net interest income.
yeah, yes, exactly. And well, that's why their investment activities are doing so good.
Yeah.
Um, but I'm just saying that so
But that
our
also means they're
economy.
overexposed.
Yeah, well, yeah. I mean, you have to. If you're seeking out returns and the avenues for risk-free return are decreasing, you have to go out into riskier and riskier places to find the same return, right? And that's just basically what we're seeing. But in terms of the economy, right, and economic growth, right, we have one of three situations. One is the economy recovers more quickly in spite of rate increases, bringing up inflation, or the economy, which it has been softening faster than expectations, which should give you some worry about the trajectory of the economy. It goes down faster than expected, and then in the middle is the soft landing in like this sliver of probability, right? The economy is the momentum of the economy is really hard to reverse, and it's really hard to get to do exactly what you want. I've
Yeah.
I've I I would venture to say we have never been able to get the economy to do exactly what we want, at least without any sort of knock-on effect that reverberate through. Like, QE, we can make the economy grow exactly how we want, but there's knock-on effects like inflation. We can raise rates to get economic growth to slow how we want, but there's knock-on effects like declining GDP and rising unemployment. And
Yeah.
while we may not have seen some of those yet, that's, I think, once again, purely it's a lag effect from just how much QE we did in 2020 and 2021.
Yeah, I agree. Yeah, I
So
think we've still yet to realize a significant majority of the effects of the federal rate increase, and that's because, well, there's been so much money we haven't had to realize any of them yet, right?
not in any real way.
Yeah.
We've seen industrial growth slow significantly, and we've seen, certain things look bad, but the reality is that there's still money flowing in a appreciable amount.
Yeah, I mean, I think when you look at the market's reaction to JPOW, right? Um, and the federal rate increases, a lot of the fear and the forward pricing was priced in, into this period, right? Um, where we stayed at, the same relative low. This is when the lagging effects were expected most. They simply didn't occur at the time when people thought they would. And so, we got this partially. This is obviously not the only cause, but we got the rally because there were no symptoms of the federal rate increases hampering growth or availability of credit. But because there's so much money in the system, the soft landing trajectory is still like here, and we've just skewed away from it massively. But a correction in that, and the realized effects of those continued higher for longer rate increases, um, they'll come home to roost, right? And so the further we pull away from that trend, the more rapid the descent back to that trend can be.
Yeah, and that's we saw an earnings recession in 2022, right? But that could have purely been, and this is where it gets like weird, right? Like the intersection of the real economy and the markets, right? People saw that J Powell was increasing rates, and they're like, "Yep, there's going to be a recession." People cut back on spending and all these things, and then they didn't lose their jobs, right? Like, so there was this earnings recession that happened that was likely driven mostly by sentiment and not by actual fundamental changes in the economic backdrop. And while everyone got into the recession prediction game, in 2022 as number went down, they were all saying the same thing they're saying now, just on the other side of the coin. They were saying recession tomorrow, recession tomorrow, recession tomorrow. Now they're saying recovery tomorrow, recovery tomorrow, recovery tomorrow. And this is why I just don't really trust analysts, because they're not really asking themselves, okay, maybe we didn't end up in a recession as quickly as we thought. Why is that? And instead they just go, oh, nope, recession's over, canceled, soft landing. Like it's an all or nothing sort of fallacy, and I find it frustrating to listen to, because people buy into it, and like I mean, like, buy into it literally, and also like they subscribe to that mentality as well, and they don't look deeper at what's going on, right? Depositor flows are still not good. It's just it just doesn't look to me like there's any sort of recovery or stabilization actually happening, right? There's stagnation happening, but is that really a recovery from what happened in 2022, right?
Yeah,
It's just
I no, I agree.
anyways, rant over. I don't. I get it. It's frustrating, and it's a painful prediction to make when it doesn't materialize tomorrow. But the reality is still there. The big issue is still there. JPOW raised rates an insane amount. We're at costs of debt not seen since pre 2008. And in the face of that, the economy is still running strong, and the only two options for the Fed, for the foreseeable future are don't hike or hike, right? There is no cut in sight for the Fed, and if the economy just hangs out here and doesn't, peter out, then we're just never going to go back down to 2%, or 3%. Like, why would we? Like,
Yeah.
real rates are not, like, if the economy rebounds, real rates are going to get loose again. Like, it's just, so you can't lower interest rates unless inflation really does come down.
I mean,
And
I
there's
think the Fed had an intention of raising rates rapidly enough to trigger a crash, and then they were going to pull back. But they didn't factor in the M2 supply. They didn't factor in the velocity of money. They definitely didn't factor in the velocity of money in a foreign, like being offset in a or increase in a foreign central bank transactions, right? Um, and then, nothing broke, and they keep raising, and still nothing's breaking, and the market refuses to price in the lagging effect now because it priced in a little bit of the lagging effect before. Um, and so, yeah, I mean, eventually that's going to have to be priced in, or we get a crash, like something actually does break, and then they can lay off the gas pedal or maybe apply the brakes a bit.
Well, I mean, technically they'd be pulling off the brakes and hitting the gas pedal, right?
Well, all right, yeah. I don't know if they'd snap to QE so quick.
That's
I don't think they
it's very
can.
interesting,
Like
right?
everyone talks about that. Yeah. Everyone, like, you see a lot of people like the more contrarian in the Discord bring that up a lot. They'll bring up like, oh well, it doesn't matter because they'll come in with QE at the bottom. But can we? Like with the U.S.'s current financial conditions, I don't think we can handle more QE. Not that we wouldn't, right? Because we're definitely that stupid as a country. But our debt to
Well, if we have
GDP is
like,
almost 100%. I mean, it's fucking, you just can't. You can't. There's no more bailouts. They did them all. They did them all at once in 2020.
yeah, and not only that, but if you still have core inflation above 4%, right, and if headlines moving up and the financial system collapses at the same time,
Yeah,
like at that point, yeah, you have two choices: either one, let the fucker burn, or two, usher in quite literally a new paradigm.
well, we've been pushing off a true collapse since like the 80s, right? So it's about time.
I mean,
We need a good. It's the 20s, man. It's time for our every century depression.
yeah, like it depends on how far back you ascribe moral hazard to economic growth, right?
Yeah,
So there's a case to be made that since the 80s, we've just, thrown caution to the wind and gotten so greedy collectively that we fail to see, like even we to some degree all fail to see uh, the long-term tail risk to massive aggregate risk-taking behavior, right?
yeah, oh yeah,
And that's kind of why, like, sometimes in our late night, penal contact sessions, I just start getting in these spirals of bearishness when I extrapolate forward some of these things, right? And why the worst case scenario would be a market crash with a crashing dollar, and that's like one of the signs that we are probably going to enter a depression, a stagflationary one at that too. Um, it's just terrifying to think about because the real implications, societally are awful. Like then we're
yeah,
talking like actual like the robbing at gunpoint over groceries kind of things happening. Like
yeah.
so, I try not to get there, but the reality is that, especially since 2008, when we discovered just how powerful money printing was and then just leaned into it super hard in 2020 and 2021, right?
Don't,
We just
don't,
the
it's,
moral hazard got to the top. Like it's just it goes all the way to the top at this point. The Fed, rather than sticking with their dual mandate, just completely capitulated to the employment rate, right? And
well,
I, I don't know. I understand why, because you don't want like people losing their jobs can affect pricing stability significantly, but on some level, you have to accept that there is going to be pain in the jobs market in order to get true price stability that is not artificially created through the production of more money
mhm.
and more debt. So I I hope my bull case for the next 10 years all hinges around us uh us having the pain now, right? We really tighten credit conditions for real. We collapse the Japan carry trade, crash the market or whatever, and then, make it so bank lending is actually painful, which is what J Powell was hoping to happen and never happened.
Well, I mean, this round of inflation isn't really being funded by banks, though, right? So raising rates is, while really effective against over inflation driven by over lending, that's not really the situation we're in, right? I mean, if over lending has occurred, it's been on the Fed side.
Well, I mean, there's a reason. There's a reason why AAA is yielding less than the 2 year.
Yeah, I know.
Like, and that's mostly what I'm talking about, right? And what that tells me is that mega corporations, AAA investment grade corporations, still have access to relatively cheap debt, and there is lending going on in there. And banks are tightening their lending standards, of course, but we haven't seen a real contraction in the availability of debt, purely because there is still a way to synthesize a yield curve that is advantageous for a bank.
Yeah,
And until that gets corrected, right,
it'll
we're gonna,
continue. Oh, well,
yeah,
it'll continue to be incentivized.
yeah, exactly. And so that's mostly what I would want to see uh, get sort of disrupted, right? And you'll see a lot of unemployment from the financial system more than anywhere else.
Probably.
But the knock-on effects are you will see that there'll be almost like an economic contagion from that, right? As access to credit dries up for small businesses,
Mm-hmm.
um, and it would suck. It's absolutely gonna suck for everybody because there's nowhere to hide in that kind of environment. And especially with the hubris of the general consumer, right? Like, we've the classical, definition of financial responsibility is to accrue savings, minimize debt. But right now, and for the past, 15 years, the incentive has been to minimize savings, maximize leverage in order to uh, gain access to assets, right?
Mm-hmm.
And so with that, especially because we haven't seen a large spike in unemployment since, we have this hubris that this is the way to gain wealth and it is, right? It's not like it's not a way to gain wealth and accrue, net worth, but the risks associated with it have been left to the wayside, right? Like if you have a house that you bought in, at the 2020 lows with a, 2% interest rate, you're doing great, but you still have a monthly payment. If you bought a bunch of houses, right, you still got those monthly payments, and yeah, you got a job, you're doing great, but what happens if that job goes away? People don't ever think about that anymore. Jobs are just there. Oh, I lost my job, I'll just go find another one. That is a very unusual economic circumstance to be in, and
Yeah.
I don't think people realize it.
I don't think it'll persist either.
No, it'll take
Yeah.
a while to unwind because of all the changes that happened in 2020 and 2021, but it's not the norm, and our reversion to the norm, I think, is going to be incredibly painful as job hoppers who are pushing their wages up, they go to hop a job and then there's no other job to hop to, right? And now what do, right? You go back to your old job and they're like, well, actually, that position's no longer available, right? It's going to be kind of a cold shower for a lot of Americans, especially those who entered the workforce between 2015 and 2017, right?
Yeah.
Who just have all the hubris in the world and just, think that they're always going to be able to find a job. It's going to be a rude awakening. But I hope it happens, right? Because it'll bring us back to rationality, right? And
Yeah.
that's my 10-year bull case, is we become rational again as a
I do think the
populace.
government's taking the right steps and onshoring manufacturing and trying to bring back um, some of our productivity to the US, right? And because we need to regrow that middle class wage base desperately, um, or we'll never have any kind of sustainable wealth equality. And the events that we're talking about, while they sound terrible, they could actually lead to a much brighter next 50 years for economic growth, right? So
Yeah, we need
they're
it.
not all bad. They're it's just a necessary part of the cycle. And yes, Jen, I'm aware that sometimes we turn to talks of the depression, but there are similarities, you know,
There
a lot of them.
it's crazy. Well, there's just, it echoes so many different periods in time, right? And I don't want a depression. I don't want to fear on a depression. It sounds terrifying. I'll probably lose my job, right? Like, that's not something I want to happen, but there needs to be something that happens, right? Like in my mind, I see the most likely outcome and the most healthy outcome as a prolonged recession, right? Where economic growth has stagnated. We get a little bit of stagflation, but then, everything sort of normalizes to the point where the Fed does have the wiggle room to, loosen up policy just a bit, right? But not go crazy and start buying up MBS and shit, just
Yeah.
loosen up a bit to let the banks have some breathing room,
I mean,
you
I think
know.
the banks have become over concentrated risk wise, and we still need a greater collapse in the larger like GSIB banking infrastructure.
Oh, I
We
hope all
need
the
we need to
GCs disappear.
we need to spread out that risk desperately. And
Yeah.
right now the path we're on is one where that risk becomes concentrated even more at the Fed, and that's not sustainable for America's economy moving forward, which is something that Fitch made very clear this last week.
Well,
So
yeah, I mean, and
we need a plan for that on a government, like a political level, unfortunately. And we need to make progress towards that goal unilaterally, and that's a big ask, given especially given how divisive American politics have become. Because it's not a
yeah.
situation where you can put off the negative effects onto one economic group or another. It's a situation where all economic classes have to suffer equally, um, and that is very unappealing to Americans.
Oh yeah, especially a very small subset of them that happen to be inside that group of concentration, right? I
Yeah,
mean, we're like and the craziest part, right, is that as the concentration has gone up, right, the probability of being able to redistribute that risk goes down. You purely from an influence perspective, and we see the side effects of this concentration in the bond and equity markets and commodity pricing. Like you're absolutely right that we have concentrated risk into just a needle point, and it's I'm not going to say that all the GSIBs are run terribly. In fact, I think JPM is run okay, right? I
yeah,
think I
yeah.
think I think Jamie Dimon does a pretty good job, right? But like Wells Fargo and Bank of America and some of those guys,
But
like
you can't be a GSIB without taking on the risk of the rest of the GSIBs, right? It's just I
exactly,
mean, like
yeah,
you have to. You're either the party to the swap or the counterparty to the swap, right?
exactly, yeah. And so like it then, like that's why I sometimes I just, say, off the cuff that I want the GSIBs to disappear. It's, I don't want the money to disappear. I just want the GSIBs to be broken up into like, 100 or 200 different banks each.
There's a lot of similarities between like the golden age and the Great Depression right now. We have this huge concentration of wealth distributed very, very narrowly. And we have, extreme over exuberance in financial markets. And I mean, I don't really know what the outcome of those two like macroeconomic events combined will look like, but I don't think we're far off in assuming that it will create some pain over the next decade.
Yeah, some pain, man. Yeah, just a little, just a smidge, just a pinch,
It's
slight pinch. Let me tell you,
gonna be a hell
yeah,
of a pinch.
yeah. I don't think people realize how much our economy runs on the growth of debt and how badly our economy needs a contraction in debt. We're at a crazy, crazy stage, and it's just it may be the craziest part is it might be sustainable, right, for a period of time. And the issue with it is the more we allow it to continue, the harder we have to push. It's like Sisyphus, right? Like we have to, or I guess not really, but we have to, like, it's the law of growth that we have to amplify the signal more and more as the problem grows larger and larger, right? As our debt to GDP grows, right, and we have to make interest payments on the debt that we're issuing, or that the debt that we're issuing. The more we have to create money in order to pay said debt, and you can there's a sustainable path for this, but it's not the one that we're on, where we have boom bust cycles and we're not actively managing the situation.
Yeah.
So I'm all for some money printing, right? Like, I could get down on the money printer. I'm not saying we should have a fixed money supply, but we shouldn't do this thing where we, are like really fickle with how we manage it, and we're really situational about it and all this stuff. We need to have more of a structure than we currently do.
Sometimes I forget our audience when we're going in these deep in these conversations during but why
Yeah.
does the Fed even matter? Let them all fail. What does this matter to poorer people besides borrowing and home interest? Food inflation, rents, employment availability, wages and income. It affects the poorer people more than anybody,
Oh yeah,
because
here, let me
everyone's
put it this way.
incentive is to shunt the problems onto them.
Yeah, let me put it this way. You're a poor, right? And all this shit's going down, and you've got, you're like, oh, sweet, the Fed just cut rates to zero. I'm going to go refinance my house and open some new credit cards and refinance my car loan. You go to the banks and they tell you to fuck right off, and they don't do shit for you. That's what happens, and it'll be like that for years. Like, where and the worst part as a poor is that you're going to be paying more on your groceries, and at the same time you're at a significant risk of losing your job, right? And if you do lose your job, now you have these high interest rates, no way to refinance them, extremely high cost of living. Like, it's especially it's an outsized disadvantage for the poor versus, the wealthy who have the ability to weather this, right? Like, it's definitely worse for them. I mean, the richer you are, the more significant an economic impact you can handle. And we have sort of, our risk tolerance has gotten so high economically in the lower percentiles that
I
our
made a
ability to weather large economic impact has gone down,
I made
like,
a nice
significantly.
chart to explain this.
Yep, pretty
So
much.
if you're wealthy now, the next time asset prices fall, you can become more wealthy. But if you're poor now, you can't take advantage of the next price and the next fall in asset prices because your trajectory looks like this.
Yep.
So to create balance in the economy, you need wealth to fall alongside asset prices. That way the poors can hop on board.
Yeah. And you can think of it like exponential growth, right? Like, or like a, compounding growth, that whole idea. The compounding growth is your wealth increases, right? The slope of that line becomes just so much greater than, someone who is, if they actually, this is why drawbacks are so painful, right? Because starting from a lower number means your compounding growth is significantly slower. So when you have these disproportionate impacts on people with low net worth who already have a slow compounding growth, you've basically flatlined it. Whereas with the wealthy, you have merely reduced the slope of their upward trajectory. You know what, Mr. Poopy Pants, you should just give up and DCA into VTI. I think that's I honestly, I do think that DCAing into index funds is not necessarily a bad idea for a vast majority of everybody. Honestly, I would say that DCAing into a 60-40 of bond and index ETFs is probably the safest investment strategy for including this Discord 95% of people. So
yeah. I mean, that's always true.
Exactly. Yeah. It's just a universal truth, and it's not. I don't think that's a bad thing, and it's why market go up. But like
Will this
it's because
stream
it's a smart strat.
become Girk eating Trader Joe Sammys during a depression? Maybe. It's a possibility.
They're not going to be Trader Joe's Sammys. They're going to be government crackers.
Hopefully by then you guys have learned to sell theta effectively.
They're not going to have margin.
Fuck bonds. Bipolar Bear's getting all manic because we're talking about his 401k going to shit. Very, very upset about that when you bring it up.
Yeah. Oh, Girk, something interesting happened. I was having a discussion with someone in San Francisco.
Mm-hmm.
They were talking about TIAA CREF bonds and their ESG bonds.
Mm-hmm.
Apparently, they're going hard in the paint with real estate right now. And apparently they've been going gangbusters. This is from a dude, right?
Well, now we know where they're lending the Japanese money. If it wasn't just being used to pump liquidity through the FHLB.
Yeah, I mean, well, apparently, and this was interesting to me. The ESG real estate market has been doing quite well, according to this dude who was some sort of ESG consultant. I found that interesting, and so I'm gonna look more into it. I just wanted to throw that at you, just a little chaos grenade in your mind to get you thinking about the real estate market.
Can't wait to get on board with some sustainable investing.
Oh yeah, right. So it's interesting, but yeah, no, the whole situation right now is just so
make Bill Gross proud.
I don't know. In terms of next week, I think we're at the point now where we're probably going to start going down for a little pullback. I don't know where to. Maybe just fill that little gap there. That's what we're looking like we're going to do.
Well, as long as we don't fall below the JPM long puts.
Exactly. It's going to be it's going to be a tight one, but we might just fill that gap and then have a nice little round off and the party can keep going, but at the same time, after that Japan news, I have a feeling that on some level, some people are suffering, from the contraction in the carry trade. So that might take a whole quarter or two to play out. It might not.
It's pretty
You,
rapid, but yeah, it can have lagging effects for those with less exposure.
yeah, and you just there's
Although
no way to tell.
the ones that wait though can be worse off because the situations the situation gets worse as the people who've taken higher risk begin to risk off, right?
Yeah, and like there may be groups that have no choice in the matter, right? And certain obligations that force their hand, to play a certain way.
Yeah.
So and with what we've seen and what we're hypothesizing about, the whole interest rate swap trade, the Japan carry trade, it could take some time for the effects to be realized in the real economy and the real market, right? And by the real economy effect, I mean more so the effect on bank liquidity.
When the
But
depression comes, how many of us who have puts will lose money due to our own stupidity? More than half.
well, the thing about a depression is,
You're gonna lose money no matter what. Yeah.
yeah, and you don't. There's no such thing as enough theta, and the market doesn't just go straight down, right? Like in a stagflationary depression, the market's just going to go sideways for a year or two or 3 or 4, right? It's not just going to go down and like constantly, and every put you buy is going to go to the moon. It's going to be extremely painful for everybody. Shorts getting in, shorts getting out. People hedging with derivatives. It's going to be a fucking mess. So I mean, puts
I'm,
are smart, but only when a recession starts getting priced in, or when growth or something starts to look a little shaky, or sentiment
yeah,
shifts.
puts do more to protect your wealth than grow it. But um
Tell that to my puts.
they can grow. They are leveraged. But hold on, let me get a couple questions and then I've really got to go. It was run too long. I'm very uninformed on this kind of thing, but I don't know how anyone gets a business loan to begin with. You apply for one.
It's like getting a
You
car
have to
loan.
have money to be given money? No. So realistically, it's really hard for anyone who's not already wealthy to open a business unless it's online. Also false. There's a lot of lending programs. There's programs for women. There's programs for minorities. There's programs for um, you know uh, government service and contract facilitators. And there's a million different SBA programs where you can qualify for a loan. People just don't want to do the research to figure it out. It's pretty easy to actually start a business. Most people wouldn't be successful in starting one, but it's not that hard to get capital to start one, generally speaking. That's tightening now. Um, but actually, right now is a great time to start a business if you could start one that's recession proof, like something in durables or consumer staples, something like that, because banks really want to lend at high interest rates, and loan demand right now is very low. So during periods like this, it becomes much easier to get capital to be like fund a business, but um, you also have to take on more risk in starting that business. So the success rate is going to be significantly lower in businesses that start during this period, although more
Yeah,
will
better
get
be a good
funded.
business.
Yeah. Let's talk strategy. What price and expiry for debit put spreads? I'm not going to build your options positions for you. Awesome stream, Greg. Thanks in the quants. And quants. No problem. Yep. Thank you, Dork, for coming on. I appreciate it, man. It's always good talking with you about this kind of doom and gloom shit before we get into our late night sessions of looking at zero DTs on SPX. Um,
Yeah, ultimately the time frames, like they're super ambiguous. I can't I can't say market crash tomorrow, depression the next day, but I mean,
Yeah,
the
it
trajectories
could
don't
be
look good.
faster. It could be much slower, and the government definitely has the tools to delay it for a long time.
Fucking long time.
Yeah. So
Goddamn.
thanks for being on here, man. I'll see
Yeah.
you maybe later today. Um,
Yeah, for sure. Hit me up if you want to touch dicks.
yeah, absolutely. And then for the rest of you guys, thank you so much. I'll have Pickles picks out tonight, and I'll see you all tomorrow. Have a great weekend, everybody. Later.